This is what every California senior needs to know about how Social Security gets taxed at the state versus federal level. The rules are completely different, and understanding both can save you thousands of dollars every year. Let's start with the good news. California does not tax your Social Security benefits at all, and it doesn't matter if you receive $20,000 a year or $50,000 a year in Social Security retirement benefits. The state exemption is absolute and applies to everyone regardless of total income. Social Security retirement benefits, Social Security disability insurance, and survivor benefits all get the same treatment under this exemption. Railroad retirement benefits fall under the same rules, and the whole thing is written into California Revenue and Taxation Code Section 17085. That means it's law and not subject to annual budget decisions. More than 10 states still tax some or all Social Security income, including Colorado, New Mexico, and Vermont, but California takes a different approach. For retirees who live primarily on Social Security income, this provides real relief from state taxation. When you file your California state tax return, you report your total Social Security income as requested on the forms, but then California provides a subtraction so no state tax is owed on these amounts. The math is simple. Zero state tax on Social Security, no matter how much you receive. Before you celebrate too much, understand what California does tax heavily. All other retirement income is fully taxable at the state level, which means every dollar you withdraw from a 401k plan gets taxed, every dollar from a traditional IRA gets taxed, and every dollar of pension income gets taxed. 9 income tax brackets range from 1% to 12.3% in California. An additional 1% surcharge applies to income over $1 million, bringing the top rate to 13.3%, and for context, that's one of the highest state income tax rates in the entire country. The state also has a high sales tax base rate of 7.25%, with local rates often pushing it higher. Property tax rates sit at 0.71%, which sounds low until you remember that California real estate values are among the highest in the nation. What this means in practice is that California retirees are not off the hook when it comes to taxes, and most other sources of retirement income face significant state tax exposure. For retirees who've spent decades saving in tax-deferred accounts like a 401k or traditional IRA, those required distributions in retirement can significantly increase state taxable income. Residents age 65 and older can claim an additional personal exemption credit of approximately $298 for individuals or $596 for joint filers for the 2025 tax year. Qualifying seniors may also claim a senior head of household credit equal to 2% of taxable income, up to a maximum of roughly $1,060, but these breaks are modest compared to the overall tax burden. If you're already seeing how this applies to your situation, do me a favor and hit that subscribe button right now. We're covering the most important tax topics for California seniors every single week, from property tax relief to Medicare costs to required minimum distributions. The information in these videos can literally save you thousands of dollars, and subscribing means you won't miss the strategies that apply to your specific retirement situation. Alright, let's keep going. Now let's talk about the federal government, because this is where most people get surprised. The federal government does tax Social Security benefits, and the rules are completely different from California's rules. Up to 50% of your Social Security benefits may be taxable at the federal level if your combined income falls between $25,000 and $34,000 for single filers. For married couples filing jointly, that range is $32,000 to $44,000. Once your combined income exceeds $34,000 as a single filer or $44,000 as a married couple filing jointly, up to 85% of your benefits may be taxable. These federal tax thresholds have remained unchanged for several years and continue to apply in 2025. The key term here is combined income, and this is where the confusion starts. Combined income is not the same as your adjusted gross income, and the IRS calculates it using a specific formula. Your adjusted gross income plus non-taxable interest plus half of your Social Security benefits equals your combined income. A married couple receives $40,000 in Social Security benefits and withdraws $30,000 from their traditional IRA, so let me show you how this works. Their combined income calculation looks like this: $30,000 in IRA withdrawal plus $20,000, which is half of their Social Security, equals $50,000 in combined income. $50,000 exceeds the $44,000 threshold for married couples, which means up to 85% of their Social Security benefits becomes federally taxable. But remember, California still taxes $0 of that Social Security while fully taxing that $30,000 IRA withdrawal at California income tax rates. One of the biggest surprises for retirees comes from required minimum distributions. Starting at age 73 as of 2025, you must begin taking RMDs from traditional IRAs, SEP IRAs, simple IRAs, and most 401k plans. The IRS designed these distributions to force you to pay taxes on money that's been growing tax-deferred for decades. A formula based on your account balance and life expectancy determines how much you must withdraw each year, and if you miss the deadline or withdraw too little, you face a penalty of 25% of the amount not withdrawn. That penalty drops to 10% if you correct the error within 2 years. Here's the problem. RMDs count toward your combined income for federal tax purposes, which means they can push previously non-taxable Social Security benefits into taxable territory. You might have structured your retirement income carefully to stay below the thresholds, but then RMDs kick in and suddenly a large portion of your Social Security becomes federally taxable. A single filer receiving $28,000 in Social Security keeps their other income minimal to avoid taxation on benefits, which puts their combined income at $14,000 from half of their Social Security and keeps them well below the $25,000 threshold. But then they turn 73 and their first RMD is $15,000. Combined income jumps to $29,000, which is the $15,000 RMD plus $14,000 from half their Social Security, and they've crossed the threshold. 50% of Social Security benefits become federally taxable, all because of a withdrawal they were legally required to make. Understanding these rules opens up planning opportunities that can save you real money. The first strategy involves Roth IRAs, because Roth IRA withdrawals are completely tax-free and they don't count as taxable income for federal purposes. That means they don't contribute to your combined income calculation. If you can structure your retirement income to draw from Roth accounts instead of traditional IRAs, you can keep your combined income below the Social Security taxation thresholds. This requires planning years in advance through Roth conversions, but the tax savings can be substantial. Timing provides the second strategy. Delaying Social Security until age 70 increases your monthly payments significantly while you withdraw from other sources during your 60s and early 70s, potentially at lower tax rates before Social Security benefits get added to the equation. Qualified charitable distributions offer the third strategy. If you're charitably inclined and over 70 and a half years old, you can make direct transfers from your IRA to qualified charities, and these transfers count toward your RMD requirement, but they don't count as taxable income. In 2025, you can transfer up to $108,000 annually per individual. The beauty of QCDs is that they satisfy your RMD without increasing your combined income, which means they don't trigger Social Security taxation. You don't get a charitable deduction, but you also don't generate taxable income, and you can still take the standard deduction. For higher income retirees with a large percentage of income from Social Security, California's total state tax burden can actually be lower than states with lower income tax rates but that do tax Social Security. States like Colorado partially tax Social Security even though their top income tax rate is lower than California's. The calculus depends entirely on your income mix. If most of your retirement income comes from Social Security, California's exemption provides major value, but if most of your income comes from pensions and IRA withdrawals, California's high income tax rates will take their share regardless of the Social Security exemption. Recent federal changes for 2025 include a temporary additional deduction of $6,000 for taxpayers 65 and older. This deduction runs from 2025 through 2028 whether you itemize or take the standard deduction, and it phases out for singles earning over $75,000 and couples over $150,000. Eligible California seniors could deduct up to $23,750 if single or $46,700 if married with both spouses 65 or older when you combine this with the regular standard deduction and the existing additional amount for those 65 and older. This doesn't change Social Security taxation rules, but it does reduce your overall federal tax burden. The biggest mistake people make is assuming that California's exemption means they pay no taxes on Social Security. Federal taxes still apply based on your combined income, and those can be substantial if you have other retirement income sources. Not planning for RMDs is the second mistake. Many retirees are shocked when they turn 73 and suddenly have to take large distributions that push their Social Security into taxable territory, and this should be anticipated and planned for years in advance through strategies like Roth conversions or strategic withdrawal sequencing. The third mistake is not understanding the combined income calculation. The formula isn't intuitive because you have to add half of your Social Security to your other income even though that half isn't necessarily taxable, and this provisional income formula catches people off guard every year. California seniors face a split taxation system where the state provides complete relief on Social Security but the federal government taxes up to 85% based on total income. The state exemption under Revenue and Taxation Code Section 17,085 is valuable, but it doesn't eliminate federal tax exposure. Smart planning means understanding both sets of rules. Structure your retirement withdrawals to manage your federal combined income, consider Roth conversions before RMDs begin, and use qualified charitable distributions if you're charitably inclined. Take advantage of the new $6,000 senior deduction while it's available through 2028. The complexity of having two different tax systems can work in your favor if you plan ahead. California gives you a break on Social Security, so use that advantage to focus your planning on minimizing federal exposure through the strategies that make sense for your specific situation. The rules are set, the thresholds are known, and the tools are available. What matters now is using them correctly. If this video helped you understand how California and federal taxation work together on your Social Security benefits, I need you to do two things. First, hit that like button so more California seniors can find this information. Second, leave a comment below telling me what topic you want covered next. Should we dive deep into Proposition 19 and property tax transfers? Talk about the new $6,000 senior deduction and who actually qualifies. Cover Medicare IRMAA and how to avoid those higher premiums. Your comments directly shape what videos we make next, and I read every single one. Thanks for watching, and I'll see you in the next video.